I don't know if you know, but today is National Define Loan Terms Really Quickly Day. Hello, and welcome to Personal Finance. It's a podcast that takes a look at everything life, everything money, and really brings it home and makes it personal. There's a lot of people supporting you and standing behind what you're trying to accomplish in your financial goals, and this podcast just takes a look at those people and brings everything home. Welcome to Personal Finance. All right, well, welcome everybody. Glad you could join us today again for another episode of Personal Finance. We're here today with the Jarrett McPike, our VP of Lending. Should be a pretty fun afternoon of just chatting about lending and the loan process and all of those different questions you have when you try to, make an application or start an application for any type of loan. So we're going to jump in there real quick, but before we do that, you know what, Jarrett, in an effort to make this personal, name of the podcast, Personal Finance, right? Bringing it all together for our members. Tell us something personal about you. What do you like to do on the weekends?
I really like golf. I play a lot of golf. I'm honestly playing golf just about every weekend. So, not very good at it, but enjoy it.
Nice. Golf. Even with a small kid, you get to play every weekend?
Yeah, just had a baby last July, and that has absolutely cut down on the amount of golf I've been able to play.
So, how's your handicap look?
Increasing.
Nice, nice. And that's metaphorical and literal. You'll find out. I have a couple older kids, so that handicap only grows as the kids get older. So
Oh, I'm figuring that out.
yeah. Well, thank you so much for joining us. We're certainly happy to have you. Appreciate you taking some time with us. It's actually a pretty big topic today. It's practically 50% of our business, right? We're taking in deposits and then we're loaning them out. So you oversee a big chunk of our lending operations. So we're going to dive into that pretty quickly. Before we do this, I don't know if you know, but today is National Define Loan Terms Really Quickly Day. Did you know that?
Yeah, absolutely. It
Not
was on my
not a
calendar.
not a made up holiday at all. It's not at all. But I'm pretty sure Hallmark has some cards for it. So if you're at the grocery store, go ahead and grab one. So let's jump into this. It seems really overly simplistic, but what's a loan?
Yeah, like you said, it is simple, but a lot of people don't really know uh, the broadness that a loan can fall into. In simplest terms, it's an exchange for money from one party to another uh, for the exchange of future payments of principal plus interest.
It's a great way to look at it for pretty simple exchange of money, but the expectation is you're going to pay it back with interest.
Correct.
So again, like you said, most people don't realize how broad that definition is. Is a credit card a loan?
It is. And honestly, that's exactly what I was thinking about with people don't realize how broad it is. A credit card is just every time that you're using your credit card, you're basically taking out a small personal loan. And then with the expectation that you're going to pay that back. You don't have to pay your credit card back all at once, but you do have to pay it back
With
with interest.
There we go. Yeah. So that seems to be kind of the key term there for a loan with interest,
Yeah.
right? But that's pretty interesting too, and we'll get into this a little bit later. Maybe another term is that we need to talk about is APR, right? A lot of people think about interest rates, pretty simple, compound, those types of things, but often people don't really understand what APR means. Could you define APR?
Yeah, it's your annual percentage rate that's going to include any interest or fees or anything that are included in that loan. Um, yeah,
Pretty simple.
pretty simple.
Nice. Yeah, that's. I think I get a lot of questions often of like, well, my interest rate is whatever 6.99, but it says my APR is 7.39. What's the difference there? And it's the fees component
It
of
is
it,
the
right?
fees, correct.
Annualized over the life of the loan. Nice. All right, you ready for some more?
I'm ready.
Collateral. Define collateral.
Collateral is, well, it could be a whole bunch of things, right? It is what is used to secure that loan. So collateral can be anything from an automobile to a boat to a recreational unit like a travel trailer or a motorhome. But it could also be your own money. You can secure your funds that you have in your account for a loan. You get a slightly better interest rate if you do something like that compared to using a piece of collateral. well, an auto or
Yeah.
things of
No,
that nature.
totally understand. Collateral, just a piece of property, whether
Basically.
that's cash, car, physical property that you use to secure against a loan. Okay, well, that pushes us into kind of the next term, secured loan.
A secured loan. It's any type of loan that is secured by a piece of collateral. Again, I kind of just went through them all with autos and RVs and boats. It's got kind of a broad, uh, I guess, wide range of things that could be used as a piece of collateral.
Nice. And that is secured loan as opposed to unsecured. What's an unsecured loan?
Yeah, it's just the opposite. It is a loan that you are not securing by a piece of collateral. So just you are basically securing it with your signature. You are promising to pay back, and we call our personal loans here at DACU signature loans because that is what is securing the loan is your signature.
Nice. Handshake and a smile,
Handshake
right?
and a smile, basically.
I need some money, and we say, "Yeah, you seem trustworthy. Here's some money plus interest." Right? Nice. Well, then that also gets us into a little bit of how those things are paid back. So let's first define a revolving payment loan.
Yeah, so a revolving loan is basically you have the ability to spend, pay back, and spend again on the same loan. So a credit card is the perfect example of a revolving loan. A home equity line of credit is another example of a revolving loan. You have the ability to continue spending as long as that loan is open.
Okay. And that is the opposite or contrasts installment loan,
Yep, an
correct?
installment loan, you have a set payment over a set period of time. Generally, for a car loan, it may be 5 or 6 years that you're paying that set payment, and at, basically you have a light at the end of the tunnel with that one.
Okay. Very nice. So you also have you seem to have a lot of tools at your disposal, right? And I'm talking about you and your position, maybe not in your specific position, but our loan officers or people who create the loans or cut the deals. They have a lot of different elements at their disposal. Um, what ties that all together? And I apologize. I'm really trying to get you just to say one word, so I'll say it for you. Credit score often brings that all together, right?
Right.
So can we define credit score like just a very basic terms?
Yeah, it's basically a 3-digit number that defines your credit worthiness. Um, your credit score is going to dictate the type of rate that you get on your loan, and so a very important part of the loan process.
And is that where you guys start, at least with your process of like, hey, somebody came to us, they need some money for whatever purpose. We think really that an installment personal loan is better than a credit card because of their credit score, or what key factor does a credit score play in y'all's decision making?
Uh, to be honest, the credit score doesn't play a huge factor in it. It's what is making up the credit score. The credit score is going to determine your interest rate, like I said, but it is not going to determine whether you get that loan or not.
That's interesting to me. I always grew up with that myth of like credit score is all that matters, right? Your credit score is all that matters. Make sure your credit score is good, build your credit, et cetera, et
Mhm.
cetera. But you're kind of letting us know that that's one factor of many.
Yes, credit is obviously one of the factors that we look at. We want to know if you have comparable history to what you're asking for and things like that. But the other two factors that we're generally looking at is your character and the piece of collateral that you're trying to borrow against. So your character may be your job stability. Um,
You're not looking at my Facebook page, are you?
no, I'm not. Not at
Oh, okay.
all.
Phew. I can still get a
Not
loan.
at all. No, we want to know about your relationship here at DACU. Do you have your checking account here? Do you have your direct deposit here, and things like that? That really does take a part into the decision making. And then the other piece is the collateral. As you said, we're borrowing against the value of a piece of collateral. So if you want a $30,000 loan, but the piece of collateral that you're trying to borrow against is only worth $15,000 or $20,000, then that creates a little bit of an issue. So the collateral is a big piece of it, and sometimes can outweigh the other factors if you are in a great equity position. Same thing if it's a $30,000 car and you're only needing $20,000 on it, then that's a much different equity position that we're looking at.
And that helps us really mitigate risk, right? It's
Absolutely.
kind of what we're looking at it from a DACU perspective. What is the possibility that um, those payments aren't made or aren't met?
Absolutely. I mean, we're us being a credit union, we're lending out our members money. And so we want to make sure, every loan that we do is an investment for the credit union. We want to make sure that we're lending out our members money to people that we think are going to pay it back.
And that's not always a exact science, right?
Right.
Yeah, there's risk involved in all of it. Even perfect credit scores with great character and easy collateral can end up in a situation where they walk away from the loan or the piece of property that they've secured it against, right?
Yep, absolutely. And we perfect credit score, as you said, people expect sometimes that they're going to get approved no matter what, but I mean it may be as simple as what you're using the loan for that we don't borrow, we don't lend for that reason. You could be buying a car for your friend or something like that. That's just not something we do. So your credit score isn't going to make up for the fact that you're kind of outside our program parameters.
Program parameters. Now that's an interesting term. You want to talk about that a little bit?
I think every lender has things that they just don't want to do. Straw purchases, what I just talked about, is absolutely one of them. Another thing may be that unsecured personal loan for a down payment on a house. It's just one of the things that we just don't do.
That's really interesting. That's one thing that I've learned, being new to this world, financial institutions. I just assumed every credit union, every bank, had their list of these are the loans, pick and choose. It's a menu, but it's really not. Some financial institutions are really well suited to do certain types of loans, right?
Right.
Um, can we go there for a little bit? Why do you think DACU is well suited for the type of loans that we're seeing a lot of success in? Does that make sense? Like we've not necessarily cornered a market, but we've entered a market and we're like, hey, this is working for us. Let's keep doing that.
Yeah,
Um,
I guess to talk about that, then we can probably break down kind of how we are split up lending wise here at DACU. So we have a direct lending department, which is everything that is, your all your personal loans, your auto loans, your credit cards, and things, and we are your direct contact with that application. We have our real estate department that is, anything mortgage related, home equities, HELOCs, or purchases, refis. They'll take care of that. And then we have our indirect program or department, and honestly, they're really the engine that keeps the credit union going here at DACU. Um, they do the majority of our lending. We're signed up, I guess to explain it, they handle the relationship if you go and try to purchase your vehicle through a dealer, or if you go to a refinance company through Google or something like that. We have several that we work with. And there's a third party in between DACU and the member. And so that is the type of loan that I would say DACU is most successful at. We have a huge web of dealers here throughout Texas that you can go to and just let them know that you want to get your loan at DACU, and they'll sign you up right there at the dealership.
nice. It's also a nice entry point for us because a lot of people just don't know about DACU. They go to a car dealer, the dealer says, hey, your best deal is with DACU. All of
Hmm.
a sudden, we're introduced to somebody new. It's an interesting concept, though. Like we do pretty well in indirect, and we've got really strong relationships with car dealers in the area. It speaks a little bit to kind of our strength as a credit union, which is building close relationships with community partners, right?
Absolutely.
Including car dealers. So it's a lot about what this podcast is about, which is just explaining. Hey, a lot of times in financial institutions, you go down the path of you get big and bulky, and you've got all the bells and whistles, and it's great, but there's not a whole lot of customer service.
Hmm.
Flip side of that is you're really small, local, regional, and have great customer service, but you don't have all the bells and whistles.
Right.
DACU really does do a great job of kind of splitting the middle.
Right. We're trying to toe that line.
Exactly. And so indirect lending, I think, speaks to that. That's great.
Absolutely.
Well, you threw out a bunch of terms there. So let's break some of those down as well and start with if the credit score is kind of the foundation of an application, or um, yeah, or if the complexity of a loan is kind of determined on the credit score. Let's start with like the easiest loan, and then let's work. I should say that, not the easiest loan, the one that would build your credit the fastest, and then kind of build from there. If I'm a 16-year-old kid, and I want to build my credit, or if I want to start a credit history or start thinking about my 20s. I know most 16-year-old kids don't think about their 20s, but let's assume they do. Um, where do I start? What's the easiest way to start getting my credit score in good shape?
So, you want to start with the credit card. You want to try to keep the balance low on it. And, you know, 2 to 3 credit cards, maybe if you work up to that point, it would be a good place to be. You don't want to go crazy with the amount of credit cards that you have, but you just want to be able to show that you can responsibly make payments, and credit cards are a great way to do that.
So that's kind of the entry point to the world of loans is a credit card,
I would
right?
say so. I mean, you can start with other things, but it's harder to be approved for the other things if you don't have a history of payments.
Yeah. And I think that's where I was headed with too. Like if I'm 16, I'm not going to go straight for a mortgage, right?
Right.
Kind of one of the most complicated loans to really apply for and get. So how do I start slow? I'm thinking about that even too. One thing that could help build your credit as well is to have a checking and savings account, right? So and that's one thing you can do pretty young, at DACU, and that's one of the benefits of having a relationship, right? That builds your character.
Right.
If you have a checking savings account for a few years with us as a teen or preteen, when you get to the place where we feel you're responsible enough for a credit card, you can apply for one, and we'll allow you to come along, kind of grow in your financial responsibilities.
Yeah. Your checking account, before you have any credit, your checking account is your credit with us. Right. And so I talked about your relationship meaning a lot when it comes to a loan decision. And if you handle your checking account well, you're not constantly taking your account negative or things like that, then, it kind of shows that you are able to handle that line of credit.
Very good. Yeah. Yeah, that's interesting. I mean, like I said, I've got preteen kids, and so trying to teach them how to be fiscally responsible starts with a checking and savings account. So
Absolutely.
they can baby step into that. Nice. Okay, so we've kind of covered the credit card. So then next kind of rung on the loan complexity ladder, would you say that's a personal loan?
Yeah, honestly, I would say that personal loan and auto loan are kind of uh, back to back there. It depends on the size of the personal loan. We're not going to step out and do a $30,000 unsecured loan after you've just gotten your first credit card. But we may do $1,000 for you, $2,000 for you, depending on the reason and how well you've handled that credit card. But on the flip side of it, we may do a car for you as well. Um, Really just depends on how that relationship has grown and what your credit's looking like when you come back for that auto loan.
Would a 16-year-old who applied for a car loan who has a good history with DATQ, checking savings, and credit card, is that too big
So
of a risk?
now you got to be 18 to get
Oh, okay,
a loan.
gotcha.
Um, Simple as that. You got to be 18 to sign the contract.
Yeah, you're just trying to stick it to those parents, aren't you?
Yeah, well, if they're willing to sign, I mean, they were teaching all the life lessons up to that point.
That's true. That's true. That's true. It's always the parents' fault. No, I'm just kidding. I'm just kidding. Okay, so we've got credit cards, we got personal loans, and perhaps auto loans, kind of at the same level.
Mhm.
If we step into mortgages, then maybe a little bit later in life, what are you looking for in the program parameters for, say, a mortgage loan?
Honestly, probably more so than anything, stability. Uh, you know, we just there's so many there's so many regulations and things that are protecting or that are regulating how we can lend. We do everything is following the Fannie Mae guidelines. So it has to be, we're going all the way into the terms here, but it's got to be a conforming mortgage. It's got to be something that can be sold to Fannie Mae. So um, getting qualified for a mortgage is really more so about stability and affordability. You don't want to get into your first house and it's $1 million house. You got to be able to afford it. But again, just like an auto loan, down payment and things like that, they really influence how much you can get there.
Gotcha. And you mentioned too, with like credit scores, it impacts your terms, right? Just as much as the size of the loan.
Absolutely.
Could you dive into that, clarify that a little bit?
the term of the loan, how long we are willing to finance a piece of collateral, could actually be determined by your credit score. So, our higher tiers, a 680 and above, they can take a newer vehicle out to 84 months, and take longer to pay off that vehicle, as opposed to someone with a lower credit score. We need them to pay it off a little bit quicker, um, because it's a depreciating asset. And so, the people that have proven that they have good payment history, we're allowing them to take this depreciating asset, and at one point it may be, uh, they may owe more on it than what it's worth, but we're willing to take that risk because you've proven in the past that you're willing to make your payments. Now, that is just on the term side of it. I mean, interest rate, that's the biggest factor that comes with your credit score. A right now, somebody trying to buy a new vehicle, someone who has an 800 plus credit score, they're going to get, is it low sixes or so in the interest rate?
Yeah,
And
you had written out an illustration for me prior to when we were talking to, and I think your example was a $30,000 loan for 72 months. You said person A who has an 800 plus score will have a monthly payment around 506.
mhm.
Person B has a 620 score will have a monthly payment around 597.
Yeah, so that difference is about $6,000 in interest over the course of the loan. If
Yeah,
both people make all 72 payments, uh, person B is paying much more in interest.
very nice. So, and that's kind of where I think why I wanted to start with the terms. Once you kind of clarify what it takes to get into a loan, right, and then we wrap it up with credit score. That's kind of the foundation of what y'all look at, and in addition to character and collateral, right, the three
Hmm.
C's. I'm listening. I'm
Yeah,
paying attention.
it's good.
And once you have that, then you can kind of step into those worlds of credit card, personal loan, auto loan, mortgage, and it's really important for people to understand how that's a tiered thing. Like if you have a pretty difficult credit score at the very beginning, it's going to be difficult for you to get a credit card. Then if you do get a credit card and you don't handle it well, it's going to be really hard to get an auto loan or personal loan because now you've established character,
Right.
right? And then when you're ready to get a mortgage or if you're trying to get a house, if you haven't handled those first two or three things well, it's going to be really difficult to get a mortgage. Not impossible. You can get it, but it's going to hurt a little bit more because your interest rate might be a little bit higher because of your scores a little bit lower. Your character hasn't been proven with payment stability, et cetera. Those types of things. Is that a fair assessment? That it's kind of a not a tiered approach. I'm blinking on the word here.
Yeah, no, you're absolutely correct. It takes a lot of time and a lot of effort to keep your credit score up and keep it high. I'd say effort, but it's probably more discipline. But it's very difficult to increase your credit score once you've established some derogatory credit. Credit uh, accounts are reported to your credit for 7 years. So once you have some slow pays, as we call them, on there, where you've been 30, 60, 90 days delinquent on an account, it's very hard to separate yourself from that.
Yeah.
Time heals all wounds, though.
Time heals all wounds. How so?
Well, like I said, it only lasts for 7 years. So I mean, after the 7 years, it's going to fall off, and it's not going to show that you had that derogatory payment.
Gotcha. Okay. Um, so you can improve your score by outlasting the bad stuff.
That's one way.
Can you speed it up by doing good stuff?
Absolutely. One of the biggest things that the credit bureaus are looking at, or what they're using to determine your score, is how you're using your revolving credit.